Welcome to another episode of Beyond the Mortgage. I'm your host, Tracy Valko, and today joining me is someone who's become one of the most trusted and data-driven voices in Canada real estate, Daniel Foch. Daniel is a real estate broker, investor, and market analyst known for his sharp insights, ability to translate complex economic data into clear, actionable strategies. We're going to dive deep into the realities of the Canadian housing market, investment trends, and what's really driving change for us here in Canada in 2026. Daniel, welcome back to Beyond the Mortgage podcast. I'm excited to have you here. I really want to get a broader perspective with you right now on the Canadian housing market in 2026. Are we entering into what could potentially be a new growth cycle, even though it does look a little bit different? Are we still in this recovery phase? Is it different provincially? Maybe you can give us a broader perspective on that.
Yeah, it does really seem to be very geographically bifurcated, or maybe even the better way to say it is like it is relative to the affordability of different markets. So it shouldn't come as a surprise to anybody, but the markets that are more affordable are doing better. The markets that are not affordable are not doing well. Yeah. And a lot of this is because they're constricted by problems with debt, with people being over leveraged. In Vancouver and Toronto, we're seeing the highest increases in delinquencies on a year-over-year basis. Toronto really, GTA being sort of the epicenter of the whole thing that's happening in Canada right now. But then you go out to localized markets in Ontario, like Niagara. A lot of these places saw a big crash in price, but then sort of caught their income curve quickly. The faster that prices fell towards appropriate price to income level, the more stabilized those markets have become. Ottawa did pretty well, although it's facing its own headwinds now with layoffs. The prairies, I would say, Alberta, priced from a price to income basis, houses are pretty affordable there. And so it's been strong-ish. Obviously, Calgary, I think, went through a bit of a localized kind of mania there and is sort of cooling down, which is, it sort of was still rising and hit the top end of that price to income level. But easiest way to understand this is places where people can afford to buy houses, they're buying houses. Places where people can't afford to buy houses, they're not buying houses.
And I think there's also, because we've seen this correction, especially, again, you and I are more in that Ontario market space, we're seeing this correction where values have come down actually in some areas. Like I'm more in the Kitchener-Waterloo market. We're seeing values coming down like 5 to 10% in the last 6 months. And that's also helping those first-time home buyers that were maybe sitting on the sidelines the last 12 to 24 months get back into the market space. So in markets where it used to be really unaffordable for a lot of first-time home buyers, they're able to get back into that.
Yeah, for sure. I think first-time buyers are really like your marginal buyer now, right? Like anybody who's doing a lateral move is pretty debt limited, like if you're trying to step up or something like that, because interest rates, like usually when they bought their first house, rates were, 100 basis points, 200 basis points lower, maybe 100, right? If you're coming up on your first 5-year renewal after being a first-time home buyer in 2021, you're probably not buying another house, right? You're down on equity, you're up on rates, and the numbers just aren't going to work for you. If you're on your second renewal, maybe, you're probably still feeling that constriction. So I think your first-time home buyers who haven't owned really seem to be the ones that are driving the market a lot. And they're doing that in both the resale market they're more likely to be the buyer who is eager to catch a falling knife, right? They haven't participated in the market before. A lot of them feel victimized by monetary and fiscal policy over the last couple of years, and they feel like this might be their last chance to purchase a house. And only time will tell whether or not they're correct. I wouldn't be rushing personally to get into the market right now, but I can understand and empathize with why some people do feel that sense of urgency. And I'm not going to take that away from them if they sort of develop their own market thesis in that regard. So yeah, I think your first time buyers are really historically they've been 50% of purchasers in Canadian real estate. And in Ontario, they've been, about 33, so like a third of all purchasers. They kind of fell off as purchasers, especially in the Ontario market, BC, a lot of these more unaffordable markets. And policymakers, the Bank of Canada, the government really relies on them to push the market up from the bottom. And if we have a variety of factors making it difficult for them to do that, one being like prices, the other one being credit, and then the other one being income, because young people also have the highest unemployment rate in Canada, it doesn't really make for a compelling story that the market's going to recover. And I'm indifferent as to whether or not the market recovers, but I would suspect that if I'm a policymaker, it would be a lot easier for me to keep my voters happy if they believed that there was some economic recovery, in the next little bit that would take place.
So I want to I actually want to break down a lot of what you said there, because I think that if we've got first-time home buyers that are actually listening to this, which there would be actually quite a bit, it could be discouraging, but then there's optimism in there too. I think it's the lens that you're in right now, given that there's a lot of buyers that if they've got stable income, they might have been sitting on the sidelines the last 12 or 18 months. And I'm starting to see that as we see clients coming in on the financing side, they've actually got more of a down payment because they've been saving and they've been waiting for this right time to get in the market. But really, is there ever a right time? I think it's the right time for your situation, your family situation, your individual situation, because the market's always going to be challenging to some aspects, right? And we still, do you not feel that there's a bit of a correction here in Ontario that's going to happen?
Yeah, it wouldn't surprise me if we saw further downside risk in most of Canada. The market doesn't need to continue growing. I think that look, there's so many factors and they change every day. If you asked me a month ago, I would say CUSMA renegotiation, the trade war probably would have been the biggest headwind. And now, the Supreme Court has kind of squashed that, at least tariffs and trade war with Canada. And CUSMA seems to be something nobody's really thinking about, because now we have the U.S. involved in a war in the Middle East, and actually we're thinking less about a recession and rates coming down, and more about basically a wartime economy and the market running hot and bond yields actually going up as a result of that. So and both of those suck for buyers, right? So if we get into a recession, rates come down, but you're at risk of losing your job, and then you've got unemployment hazard, you've got AI unemployment hazard on the downside, and then you've got upside, which is rates get too high, economy runs too hot because we're at war or whatever it is, rates get too high, and that limits my ability to purchase. So, it's kind of a damned if you do, damned if you don't situation for, I would say, most of buyers right now. And this is why a lot of people sort of see me as very negative or bearish, but I actually think that I spend a lot of time analyzing this stuff, because I think it's our job as real estate professionals to outline to everybody what the worst case scenario looks like, and if they are still comfortable. Risk management is a huge job for professionals in real estate. And if we've illustrated what the risks are, and you can find a deal that still makes sense based on the worst case scenario of all of those risks being realized, then you've probably found yourself a good deal, and that would be a transaction that I would move forward with. That's becoming increasingly difficult to do as the risks get bigger and bigger, but I think that's why I spend so much time thinking about this stuff.
Yeah. And I agree with what you said, because a lot of the times you could listen to what you say and you think, to your point, a listener could think it's very negative, but you're just giving what the perspective, and really what we should be doing is understanding data to be able to relay that as professionals, so that, home buyers, whether you're a first-time home buyer or an existing one looking to move up, you're making the right choices because you have the education, right? Yeah. And I think what's good nowadays is that I am finding more investors, more potential buyers, even, current ones, they're more educated than before, because there is a lot more information that you're able to get access to, and a lot more, I think, more professionals out there that are speaking about data and what the consequences are. And to your point, what's happened even over the last weekend has totally changed where we're at right now, economically, not just in Canada, but I think globally. And now we've got, probably some potential challenges with bond yields and fixed rates that could drive, the market for people to sit back a bit more than they thought. And unfortunately, we're entering into a spring market, right?
Yeah, I think the big theme over the last little bit is just uncertainty. And I think, had the uncertainty just been the trade war, you might have headed into the spring market with a bit of a fatigue around the uncertainty. People are like, we've been dealing with this for 2 years now or a year now, and hasn't really done anything too bad. Last year's spring market was the Canadian election, so we didn't know who was dealing with the trade war. A year later, has it really impacted Canada's economy? Yeah, we've seen some layoffs, we've seen some inflation, etc. But then you get to the 1 year mark, and we're heading into the spring market, and now the uncertainty that we're facing is different. It's war, and that's a very different situation by comparison to trade war. And it's not that it's better or worse. I'd say it's probably like it tends to be net inflationary or like positive on the economy, obviously very negative for other reasons, but that's still a question mark that if I'm heading into the spring market and there's a ton of supply on the market in February, March, April, May, and I'm thinking, oh, well, there's lots of listings out there, but I have no idea what's going on with geopolitics, and we still don't really know what's going on with the trade war. I don't know if I'm going to have a job. I don't know if AI is going to take my job. I don't know if, there's going to be a ground war in the Middle East and the US and Canada will get pulled into it. Like, these are all things that we actually just simply don't know. And as we've learned in the last little bit, during the pandemic, we had interest rates as a tool to deal with uncertainties. Mm-hmm. Like, if you think about like the last 5 years is like the most uncertain time that we've maybe ever had as consumers in Canadian real estate. So you had the pandemic, and back then the central bank had the ability to say, okay, well, we're just going to drop the overnight rate to 0.25%. And then that helped people deal with the uncertainty. They're like, well, I have no idea what's going to happen. I don't know if the workplace is going to be open. I don't know if I'll ever go to the office again. I don't know if retail will exist, or I'll be buying everything on Amazon anymore, or if like this is going to be a seasonal thing that'll happen forever and we'll have to deal with it and I'll be wearing masks and social distancing for 100 years. We didn't know in 2020, but what we did know was that interest rates were the cheapest that they've ever been, or as cheap as they were during the global financial crisis. And I think that gave us the confidence that the central bank and fiscal policymakers as well, with the stimulus checks and CERB and all of that stuff, both your monetary and fiscal side were basically throwing as much money at the problem as they possibly could. Mm-hmm. Today, we don't have that luxury. So today we don't have a situation where policymakers I'm sure they would love to do all of that, but they cannot deal with the consequences of doing that right now. And so that they used CERB to create income certainty when people had uncertainty. They used the monetary policy interest rate to create debt certainty when people had uncertainty, like, debt cost certainty, even going as far as to say interest rates will be low for a long time. For the foreseeable future. It just doesn't exist right now. So they have limited tools that they can use to eliminate uncertainty. And as a result, unfortunately, we're seeing what the consequences are right now. People deal with uncertainty. If they're not given tools to deal with the uncertainty by their policymakers or central banks, they deal with uncertainty by not doing things. They pause major decisions. And that's probably the right move, especially in, if it's the largest decision of your life, if you're a first-time home buyer, largest financial decision that most people make. I think having kids is actually technically more expensive than owning a house, but it's like, I
think so.
It would be hard to convince people that that's sort of like an investment, right? It's sort of just a necessary money that has to be spent. But all of that to say that I think unless we see prices make a meaningful trend upwards, people are really not, which is just not going to happen, frankly. If anything, they'll be meaningfully trending downwards. There's no reason for Canadians to feel urgency to purchase a property, and so they're not going to. And I like to see this. It means that we've sobered up as consumers, and we're not being silly or reactionary or irresponsible with what is a very delicate and careful and thoughtful process and asset class in real estate and housing.
Absolutely. I mean, yeah, you just said it exactly. And I think that what I've seen too is, like you said, we've never seen what the correction that we've had in the last 5 years in our economy. But I think specifically in Ontario, even more than BC, I find there's been more of a correction. And that correction is making homeowners and just Canadians in general, and especially in Ontario, more financially educated more than ever before, because it's really impacted their affordability on every aspect, because inflation has driven prices up. Just the average cost of living is higher, our taxes. And I think that when you look at it now, people are very cautious in terms of making that decision of buying a house. And one thing that I really sat back and looked at, and I think you can agree with me on this as well, is in Canada, our mortgage renewals traditionally are on 5-year terms. That's where historically most Canadians, very conservative at best, would take 5-year terms, not shorter terms, but the 5-year term. So when you're up for renewal, this is where you're open to being vulnerable of either higher or lower interest rates. And we definitely are seeing the impact of that with the amount of mortgage renewals coming up in 2026. It's probably the most historically that we've seen because we did, I think, 4 times worth of housing volume in 2021. And the market that's getting hit the most is Ontario because that's where the majority of that business was done. And properties are not coming in, like you said, to the, where they're indexed to inflation, where values have gone up. The equity is not there that people had thought they had. And their payments on their mortgage, because rates are higher, are significantly higher. And I think it's bringing a reality to people that they have to understand that just because they got that rate and they're set for 5 years doesn't mean they have to not be disciplined with their financing, because interest rates can change. Like a lot can happen in 5 years. Look what can happen over a weekend with what's happened with the war.
Yeah,
so I think we have
exactly.
to be so cautious, right, on what's going on.
Yeah, it's either like I think there's like a Mark Zuckerberg quote where it's like the biggest risk that you can make is not taking any risks or something like that. But I mean, there is a pretty strong historic correlation between risk and return. And so I do think that to a certain degree, people are rewarded for being bold, but I can understand why people don't feel like that's a necessary thing to do right now. And I think that they wouldn't be wrong in saying that, it's pretty clear from a mathematical perspective that like this is, I don't even know if I would really call this a risk. It's literally just like uncertainty. And until we have certainty that like, you don't even need to know that a bottom's in, right? But that like price velocity is no longer moving downwards. Like probably what will happen, my guess would be that the prices will continue to fall. And then eventually you'll get like 3, 4, 5, 6 months in a row of like, 0% or like close to 0%. Like, I don't think we're going to go from, prices falling for whatever, we're 13 months in a row now. Prices falling for 13 months in a row to prices rising immediately. It'll be like, it'll be down and then flat and then slowly back up. So like 2027 might be a year where you'll see no price appreciation. And then eventually, usually what comes after that, it like the way that consumers think about this stuff. And like, you could think about this like with any products as well, right? If you're looking for a TV and you go to Walmart and you walk by, through the grocery and you see the TV's on sale and each week it keeps going down in price. Eventually, maybe you come back and it's not lower in price. And so you're in your head, you say, okay, well, if it stopped falling, maybe the next thing that happens is that it starts going up. And so after a year of prices no longer falling, we might start to see people confidently saying, okay, yeah, like I'm not worried about buying and then losing $100,000 in equity in the next year. And that's when people start to think a bit more about getting back into buying properties.
But do you not think when you look at these cycles that we've seen before, I mean, there's different names that you can call them, whether it's a financial crisis, dot-com bubble crisis that we had, a COVID, there's periods where there was a run up, right? Run up on interest rates, housing values started to decline, interest rates started to fall, and then the housing market started to pick up again. But in some of these markets, this is where people like right now, to your point, yes, we have challenges, but if you have stable employment and you've got the down payment, this is a time where it's a buyer's market. You can negotiate, you can put in offers, condition of financing, home inspection, really know your numbers and get into a market where maybe potentially before, even like a year or two ago, you couldn't get in at that price point because we've seen a correction. And I think this is where people have to look to see where you're at with your finances, where are you at with your income. This could be it. Because to your point, if we're flat next year, it's still a good market to be able to get in because that run up's going to happen eventually. We've seen it historically. So this is the time to be able to get in.
Yeah, I would say like, I think when I say like this is the time, I would use like a 3-year window. And I think historically, yeah, like if somebody bought in 1995 rather than 1996, they certainly did better than someone who bought in 1991, but not as well as somebody who bought in 1996. And it's pennies in the sands of time, right? Like in the grand scheme of things, if you're thinking about real estate correctly, like the 25 plus year asset that it is, it's a pretty nominal difference. But a lot of people don't think about it that way. They think about it in terms of like the 5-year mortgage term or their mortgage payment or whatever it is. And so they're trying to capture as much of that downside risk as they can with market timing. When you say like it's a market that is giving us opportunity to get good deals, get good terms, financing, inspection, et cetera, totally agree. And I think that to me is where I start to think about, is this the best Or is this a good time to start looking for deals and negotiating on deals and putting out lowball offers? Because if I think prices are going to fall 10% between now and next year, and I see a property and it's clearly listed at market value, and I can get that property at 10% below the market because we're in a really tough market and there's tons of supply and I have a really good real estate professional on my team and I'm negotiating an excellent price on that asset. Now, all of a sudden, I've just taken possession of that thing earlier. And let's go back to first-time home buyers. If I'm a first-time home buyer, I'm either renting or I'm living with my parents. And in that case, I'm maybe renting space in my mental well-being. Like there's some sort of opportunity cost with me living not in my own house that I own. So if I'm renting, I immediately forego the monthly sunk cost of renting and start paying into home equity, with a cost obviously of probably paying a little bit more on a monthly basis owning than I am renting. So, I have to pay interest, but I do get some principal back, and I own the asset a year earlier. Every month I pay the mortgage down, I am paying more principal and less interest. So it becomes a more efficient of a savings vehicle for me. And I call it a savings vehicle because I don't think that people should be thinking about their primary residence as an investment. It's really a liability more than it's an asset at the forefront. And that's fine. Like there's nothing necessarily wrong with servicing cheap debt that you also get to live in. Let's just categorize it properly. When you start to stack some of those like more nuanced and qualitative benefits, it becomes a bit more compelling to say to people, it's certainly not the worst time to buy a house, right? It's not 2022. It's not January of 2022. It's maybe not the best time, but for everyone in the market, right? Like if I were to create a global average of every market participant, is this the best time for you to buy a property? Probably not. Can it be the best time for you as an individual to buy the property based on all of the factors that you need to put into a spreadsheet or ChatGPT or whatever and analyze whether or not it's the right decision for you based on how much you're paying in rent, how much you would be paying towards your mortgage payment, how good you are at investing, how good you are at saving money? Most people haven't done this math. And if they do the math, then they'll get usually, and we have a calculator that we built on the website for the podcast on realist.ca. I'll send it over to you, but it's like a buying versus renting calculator. The break even's at usually if you're looking at like your average house of what it would cost to rent in like a GTA or like Kitchener-Waterloo, you got to be able to like get about like a 7% return in the stock market to beat that. That was easy like 6 months ago. Now it seems a little bit scarier because we're seeing volatility. AI is threatening a lot of SaaS multiples. You've got war, blah, blah, blah. Again, have people thought about all of these things and really plugged it into the spreadsheet? Some people just say like, I just want to own my house, right? And that's it. And they don't want to get too nuanced on it. That's totally fine. But if we really want to break it down, actually run the numbers, figure out whether or not it's the right decision for you. And at some point you will say, okay, this is probably as safe as I'm going to get. This is probably as good of an opportunity as I'm going to get. And I think you're starting to see that moment appearing for more people every day right now as the market gives better deals, as interest rates are kind of like reasonable, I guess. Yeah.
I think that, I'm going to go back in time a little bit for myself because I know I'm older than you. But 30 years ago, when we bought our first home here in Kitchener-Waterloo, interest rates were sitting at close to 8%. It was back then you didn't negotiate rates. So I'm really dating myself. And we were doing more 6-month convertible terms. So just for listeners, that just means that it renews every 6 months. And it's a shorter term period, which a lot of times right now we're not seeing a lot of those type of terms in the marketplace. But I remember when my husband and I did that, we weren't concerned about, I'll tell you one thing, we weren't concerned about where inflation was at, what was going on globally in the market, absolutely concerned about our jobs. And we were in the finance business back then, but we wanted to own a house to be able to put a roof over our head. And we were having our first child. And we did not think about or discuss about, okay, what's the equity position we're going to be in the next like 2, 3, 4, or 5 years. And I think that maybe we've gotten away from those type of analysis. I think it's important. Obviously, I'm a numbers person. You got to know your numbers. But I think that we have to look at homeownership as not an equity cash grab to be able to consistently use it as an ATM that we've done in the past. And specifically, I would say, over the last 7 years with interest rates lower, people were pulling money out. And that's I think works in some aspects if you're looking to build, an investment portfolio. And we'll get into investors in a moment. But I think that we have to go back to owning a house isn't meant for everyone. I think that, to your point, like, looking at that calculator is a great tool, because maybe renting is the right thing for a lot of home buyers or for a lot of young people right now, and putting your money into the stock market or diversifying, your investment portfolio. But I think people have to take the noise out and really look at what's best for them, right? Put the oxygen mask on first.
I think the truth is that like homeownership has proven to be the best for most Canadians, simply because Canadians are not good at saving or investing. And it forces them to do that. And so, there's some nuance to that. Like in the US, investing money in a business is, or the cost of debt on starting your own business is a lot closer to the cost of debt on buying a house. Whereas in Canada, that's like in the US, it's like 100 basis point or less spread. Whereas in Canada, it's like a 300 basis point spread. And so your financial incentive to, invest in your house rather than your business is a lot higher in Canada than it is in the US. But I mean, we're not a massively entrepreneurial culture right now. I think we're very much like a worker bee culture, which is fine. That's not a criticism, more just an observation. We're not competitively entrepreneurial like the US. We're not, you don't see a lot of people wanting to really get deep into stock trading, financial markets, et cetera, like you do in the US. And so it could just be interest or the limitations within the Canadian market, although it's pretty easy for us to just trade in the US stock market as well. I think the truth is that and this is changing a little bit, because you're getting people who have been excluded from homeownership by no fault of their own, just because of the policy environment and what happened with the market, that are shifting towards saying screw homeownership and investing otherwise. But historically, from a returns perspective or like a net benefit perspective, because I don't even know if you could really call it a return, homeownership has really done a really good job for Canadians of forcing them to save money and forcing them to store that money that they've saved in a hard asset. And until that stops becoming true, which it has been a little bit over the last 5 years, I would say it's becoming less true and it's been becoming a net cost. But if you spread it out over 20 years, still probably more wins than losses. Unless that balance changes, I think people will always come back to it, for better or worse. I don't think it's a good thing for our economy necessarily, but it's just an economic reality.
And do you think that policymakers will eventually see, because again, to your point, the housing market is declining, not as many buyers coming into the space, challenging on the investor side. Do you think at some point that we'll have, I'd love to hear your thought on, do you think there will be significant policy changes? We're always talking about the reduction of the stress test, and we know that that's not something that's on the plate this year, but what do you see in the next potentially 3 years? Do you see a correction? Do you see policy changing to help Canadians actually bring alive that, dream of not only home ownership, but investment?
I don't think I see a correction. I just think it's a gradual shift, and we've been seeing the shift. So, incomes are catching up to prices a little bit, or prices and incomes are getting closer together. Prices are coming down. Incomes are kind of growing, not really, barely outpacing inflation, but interest rates are a little bit cheaper. They may have some downside risk over the next, over a 3 to 5 year period, or we just stay I've always modeled stuff on what's a historic average interest rate environment, and 100-year average interest rate is 4.11% for a mortgage. We're there, right? We're pretty much in that interest rate environment. So do we need rates to do a lot more? I don't know. I feel like it's, probably not the most economically sensible way to stimulate an economy is to make debt insanely cheap, with Canadians being super indebted. Our household debt to income ratio probably needs to come down, I guess, on that note, right? We can't really borrow more. You see this all the time, right? If somebody comes in with a credit file and they're levered to the gills, you're not giving them more debt. That's the aggregate of Canada's economy right now, right? We have 108% debt to household income.
Exactly. Yeah.
You can't really borrow our way out of this problem. So what becomes the next phase is prices continue to fall, incomes continue to rise, interest rates maybe give a little bit of benefit, and then you start to see policymakers are already throwing the kitchen sink at this. The problem is that the issue is so far out of hand that a lot of the things that they can do don't really materialize in major benefits for them as it stands right now. So as an example, first-time homebuyers HST relief thing, right? So $50K from the Fed, $50K from the province, up to $100,000 or $130,000 that you can get if you're a first-time home buyer who can buy $1 million house. Well, like how many first-time home buyers are buying $1 million brand new house? Not that many.
It's not
right?
happening.
Like, it's, I mean, well, and yeah, if you're an individual who has a $250,000 household income or whatever, is that what it would take, something like that, right? 5x income.
It's slightly over 200. That's right.
Yeah. So $250,000 household income, like you're probably pretty financially savvy. You've probably got some good investments. You may already own a house, right? So like there's not, so you're not where the policy is the most beneficial is actually where it's least valuable. Where it needs to be most beneficial is the people who need to buy a house for $600K, and those don't exist in new homes. Maybe like your small condos, right? But we're not like, so there's a product mismatch and there's supply and demand mismatch. You don't have the buyers who can buy the product that builders can build, and you don't have buyers who want to buy the product that builders are building. And that's where, so I guess to answer your question, sorry, I kind of went on a couple of journeys there, but we are seeing the correction happening right now. It's just, if there's one thing that I've like really learned about this whole thing is that it all takes way longer than you expect. So, and like, true. I should have known that. I've analyzed all of this stuff a lot, the global financial crisis, I was like marginally financially present during the world during that period of time. I went through like 2016, 2017 was like, I think it was a incredibly volatile, like micro recession and like real turbulence in the real estate market during that period of time. But that was fast. Like that was a 2-year, like very fast thing that happened. Trump 1.0, micro recession, interest rates going up, 2 foreign tax policies in Vancouver and Toronto that like created that turbulence. But, go back to like the 1990s or global financial crisis. 1990s, it was like peak was 1989.
Yeah, it was 1989. Yeah.
Trough was like 96, right? So if we're saying we're gonna, and I've always said it would sort of follow the same thing, the same trajectory, like because I felt the mechanics were very similar. We're still like in the, we're 3/4 of the way there, and so a lot of these things just take time. Takes time for consumers to adjust, takes time for policymakers to adjust. Maybe we see municipalities finally get their shit together and get rid of development charges. That creates more downside risk on the market, but it also stimulates and brings the buyer and seller closer together on price. I think a lot of things could still happen and will, but they're going to take another couple of years. And so if I'm guessing on like correction and then when does it actually become stimulative in the economy, I'm not optimistic it's going to happen this year.
Yeah. And to your point on that, like I'm just looking at, I have a great chart, which I'll share for the viewers as well. Usually the correction on every cycle is about 3 years. Like even 1989, it took till 1991. Even if I looked at the financial crisis, we were looking at from 2007 to 2009. It's always that uptick. It usually takes about 3 years. Right. So I think this one's just taking a little bit longer because there's continuous headwind that we make. And you know what? I think there's also this sentiment where people are exhausted. People are exhausted from all the chaos, right? And had so much media and information overload than we've ever had before because of the influx of AI.
Yeah, 100%. I think that's the big X factor. Like everything else is or was just normal market forces, like that you could kind of play the tape to the end. But AI is like, that's not something we've dealt with before, right? Like you could say like the internet. And I do think the internet was like close to as disruptive, but it didn't replace actual work. Like it replaced sales channels, right? As an example, like it replaced markets, and replacing markets is huge, right? Like if you're shifting from everybody buying their, small incremental home goods at Walmart to Amazon, that is a huge disruption, comparably large disruption in commerce. But replacing the actual like hours of labor, I think, is a different thing, and so AI proposes a unique threat in that regard.
And when speaking of AI or any changes we've had, one thing I can say in Canada is we've been very adaptable. Like look at the shifts that we had during COVID and the technology advancement. Like we never used to do in-person. We used to do in-person meetings, especially from the solicitor side. Now it's online. Most people are preferring online. I know the mortgage industry has completely changed where we're doing almost all appointments and people are preferring that to be all online as opposed to in person. We're not seeing that shift back, and probably in a lot of other industries as well. The AI integration, I think that's changing so fast. Do you not think, let's talk about the AI, because AI is very, it's predictable to give you, the data that you study and that you're the expert at. It would be able to analyze what's happened in the past in the economy, really give us probably what's going to shape our Canadian housing market and economy over the next few years. Have you looked at that? Has that played into maybe your opinions on that, on decisions on where you think the housing market and the economy is going in Canada, or is it just too unpredictable?
I think that like a lot of factors are just math, and so those ones you just try and model for the variables that are modelable, and just I think you position for the variables that aren't modelable. So you say, okay, I know that Canada's household debt to income needs to come down, so we're going to see a period of deleveraging or asset growth that'll need to take place for Canadians for us to be able to afford to grow the economy. But I don't know how many jobs AI is going to get rid of. So I can model in decisions based on the first one. For the second one, I kind of have to say, okay, well, as a real estate professional or as a mortgage lender or as a mortgage broker, whatever it is, how do I position myself for a consumer who is probably increasingly employment concerned or fearful? As a landlord, how do I hedge against job losses as a result of that, or government layoffs or whatever? Maybe that's a good example. Like, if I have tenants that are employed in the public sector, I've already had conversations with them about how they're feeling about their employment situation and if there's anything we need to get ahead of. These are real things that actually have to happen. And so that's all you can really do. I would say, yes, like I think about all of these things constantly and I try and use them to guide my business decisions moving forward, but there's a limited scope in which you can do that. It's like, you kind of have to take them all and then say, what's like the lowest common denominator? Like, what's the decision I would make based on that whole worldview of things, and then proceed with that.
And how do you think, let's go on the AI side now, because I know you're heavily into that. It's a passion of yours. Where do you see that in the real estate industry, and how beneficial are you going to see that be for home buyers in the future?
Citrini Research put out like this report that was like kind of like crashed the stock market. I don't know if you saw that. Like a couple of the big funds were like forced to like shoot back with them. And they stipulated in theirs, like they covered the housing and real estate profession pretty quickly in there, but they said like, realtor fees could compress from like 6%, which is where they're at in the US, to 1%. I don't know if I see the compression being that substantial, but I think fee compression we can already see fee compression, right? There's billboards all over the highway that say 1% listing fee and blah, blah, blah. And that's always existed. The difference now is that the transparency of data is a lot higher, and the transparency of like what are the workflows of a professional are a lot higher. And so I think that, we've seen so many iterations of like for sale by owner, blah, 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 like all come and go and not really win the market. I think the biggest thing that AI is going to face as a headwind, and we've seen this as being an AI company, is people constantly, dunking on AI because they feel threatened by it. And when you're like, technology will be fighting the greatest sales force on earth, right? You have millions in the US, hundreds of thousands of salespeople who are all trying to peddle a similar narrative that are market movers. That's what realtors are. And so I think that eventually you will see fees compress and you will see it happen, but I don't think it's going to happen as quickly and efficiently as most people imagine, simply because you have these hundreds of thousands of people who are trying to push the market in a different direction. And like, that's not to say that that's a good thing, but that's just the reality is, what might happen is if we continue to see, or what might expedite that is that if we continue to see the sustained period of low transactions in both the US and Canada, like US is down massively on the number of transactions that have happened. Canada is down massively on the number of transactions that have happened. You'll start to see participants exit the market. And so that shrinks the sales force that's fighting the narrative, right? That is probably the one thing that could expedite it. And that's a decently likely outcome if the real estate profession can't figure out how to stimulate more transactions. The way that I really, really think that this whole thing ends is like, if you just look at a more mature, unaffordable housing market, like most of the markets in Europe, you don't see a lot of realtors. You don't see RE/MAX signs everywhere. You do see a lot of leasing agents and like a couple of really good realtors who own the majority of market share. That's the probably likely outcome that we end up with in North America. How soon do we get there? I'd say like 10 years would be the earliest, right? Like again, all of these things take way longer than we all think.
And especially here in Canada. So everybody that's listening, that's a realtor, don't panic. You got 10 years. You put that on Daniel.
Yeah.
Okay, so what's the biggest surprise for you when analyzing the market over the past 2 years?
I think is what I said, like how long things take. Like everything, it's like it's so obvious directionally what's going to happen, but it takes the market and consumers way longer to make that happen because you have your sellers that are here and your buyers that are here, and it takes them 2 years to meet each other somewhere.
Yeah. Yeah.
So that's probably the biggest one.
Okay. I'm going to give you some rapid fire questions because I had a lot of people reach out to me that I said you were going to be on my next podcast. So let's go here. Most unappreciated housing market in Canada right now.
I think the entire province of Quebec, to be honest with you. I think like it's just
very good point.
People are afraid to go there because of the language barrier, and it shows in the pricing, and you there's some pretty deep discounts and like really cool cities and markets. I mean, Quebec and Montreal are like two of my favorite places in Canada. I think they're just sleeper markets, to be honest.
Yeah. And policies are very different there, like on mortgage lending. Yeah. It is very, very different there, right? But yeah, that's a great
Well, that probably
answer.
goes with like the Salesforce side of things, right? Like you can, like as a mortgage broker, you can trade in like every province except Quebec, right? So like
That's
you don't
right.
have this all of the brokers and all of the realtors trying to help people do deals in that province from outside of it.
can't.
So you don't get a lot of like foreign or out of province investors investing in Quebec where you do in like, Atlantic Canada or the prairies.
Yeah. And very selective lenders there. Like it's very selective. There's not a lot. So I think to your point, that might shift, right? There might be some more shift because it's becoming more affordable. One data point every investor should monitor weekly.
That's a good question. I would say the biggest one is how long it's taking for properties to lease, although it's a tough data point. But I think a lot of people enter into positions where they're cash flow negative because they don't understand the nuances of what's happening in the rental market, and that can kill deals very quickly, or make a good deal from an operational perspective can make a good deal bad very quickly. So as an example, you forecast that it's only going to take you a month or to lease up your property because you're using vacancy rates from 2 years ago. So yeah, I would say that like just leasing velocity, rental rates, a vacancy rate.
Okay. And what's the biggest misconception about the 2026 real estate landscape?
It matters whether or not we are going to find a bottom this year. I think that I don't think your average consumer is trying to time the market anymore. And I think like a lot of people say like, oh, I'm going to buy when prices are down like 50%. It's like, go for it. Like, that's fine. Have fun never buying. That's cool. I don't think your marginal buyer doesn't really care. They're not trying to time the bottom. They're trying to own a house to live in. And so if you think about it from that perspective, less about like assuming your average consumer is trying to time the market, you probably will fare better.
Thank you again for everybody tuning in. And remember, the best financial decisions start when you look beyond the mortgage. Until next time, I'm Tracy Valko, and I'll see you on the next episode.